What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Kyle Floyd, the CEO of Vox Royalty. Kyle, it's good to see you.
Jay, likewise. Really good to be with you.
Yeah, I'm excited to dive into this and get this story in front of my audience, understand the story better myself, get to know you better, all that stuff. And because Vox Royalty has been turning a lot of heads with the volume of transactions that you guys have been completing since 2019. It's been a pretty crazy number. On the back of that, some fantastic revenue growth. We're going to talk about all that stuff. Where I wanted to begin, though, because we were just chatting before I hit record about the surge in newly listed royalty and streaming companies, right? And that's obviously in response to investor demand, but there's tons suddenly in the last 18 months, right? So 2 questions for you to jump in. Why should investors look at this model as, if you think it is, a preferable entry point to precious metals? And secondly, if they choose to do so, I always say to my audience, we're looking for the winners, but you can never really pick a winner because there's too many unknown variables to know with certainty what's going to work. You can pick the companies with the highest probability, but you never really know. What we can do is have hard and fast rules to dismiss that bottom 85, 90%. We want to get to a no fast, right? So do you have any rules that can help investors get to a no fast when they're looking at royalty and streaming companies?
Absolutely. Granted, they come with some internal bias that obviously at the outset I would have to acknowledge. But your first question is, well, why royalty companies? And that I think is a really easy one for investors to grasp. Royalty companies have outperformed mining companies over the last 20 years, and not just mining companies, but really any commodity-based benchmark that you want to compare a royalty company to, they've outperformed. That also includes the S&P 500. So when you're looking at outsized gains with commodity exposure, I don't think that there's been a better investment class than the major royalty companies in that respect. And so why is that? Well, royalty companies share what is essentially risk-adjusted asymmetry to their side of the table, which is they participate in all the upside qualities of a mining company without so many of the risks that afflict mining companies. And one of the major ones that we're understanding, and I've been talking about for a while, is cost inflation. You buy a mining company to get exposure to all the ounces and all the tonnage in the ground that you expect to be somewhat obviously increasing in price and hopefully increasing in volume in terms of production numbers in a buoyant commodity price market like we find ourselves in today. Unfortunately, some of that buoyancy in commodity prices is eaten away by cost inflation. So all the same inputs that we have as consumers, mining companies also face those rising costs when inflationary pressure persists. And so we're seeing that. And you've seen a number of major mining companies come out and say that that cost inflation is, in fact, eating away at their margin. Royalty companies don't have that same cost inflation exposure. So very, very thin costs compared to mining companies, a lot less risk around costs. And so that's a big deal. And that's pertinent for today when we're looking at the macroeconomic backdrop of some pretty significant inflation. So all that being said, royalty companies have outperformed. They've been a better risk-adjusted play for now decades in the commodity sector. Well, now you ask, well, what royalty companies? How do we get to a quick no? Well, Vox was started because we looked at the world of opportunity and we said, we need to offer investors what they expect to get, which is better risk-adjusted exposure to commodities. And how do we go about doing that? So we started building this business model back in 2011, 2012, 2013, formally incorporated actually in 2014. But we've been around a long time building competitive advantages that we believe have essentially been validated over the last year, present as better risk-adjusted opportunity to commodities. Well, that's why you buy royalty companies. Well, who's capable of delivering that for you? Well, I think you need to look at, if you take the majors out of the equation, because they've been around for a long time, they're pretty established, can still obviously outperform. But if you want that real big upside exposure that a lot are searching for by owning, call it the junior bucket of mining companies, well, then you have to look at the junior bucket of royalty companies. And for better or worse, we're in that category right now with aspirations to be closer to the major end of the spectrum. But how can you start ruling out some of the 20 new royalty companies that come about over the last 2 years?
Yeah.
Well, I think there's some pretty easy principles to apply. What's the depth and expertise of management? How many royalty deals have they done? And oh, by the way, royalties and the acquisition of third-party royalties have led in terms of risk-adjusted returns and absolute return on invested capital. Third-party royalty buys have led the industry. So there's a lot of new companies that are creating different niches and going after different things, whether it's micro streaming or whether that's any number of different financing kind of means to find and buy streams on assets. But most of these management teams, most of these royalty companies that have come to market over the last 2 years have very little experience in the royalty industry. And so they came in much like cannabis getting hot or cryptocurrency getting hot. Well, there's investor appetite, so let's start a royalty company. So I would say management expertise, how long they've been doing it, and their track record are very important. Most don't have a track record, and most don't have a technically oriented management team. They have a team of finance or market or newsletter writers on their board and their management team. That would give me a lot of pause for concern. Do you have the technical prowess to actually understand what you're buying? So that would be another check mark I would check. I would also look at how many true meaningful assets for their size do they have? Do they have the diversification? Because look, there's a lot of royalty companies. I can think of one, I won't name their name. They just spin out one royalty. Well, guess what? If you really like exposure to just one royalty, go buy that mining company. Because at the end of the day, they have the most exposure to it. And you're going to be directly correlated with that asset if that's all that you own. And so I would say, how many assets do they have? How well diversified are they? How look at the meaningfulness of those assets and their weighting, and make sure that there's that critical mass that's been achieved. So that's another checkbox. And then you have to look at it and say, what is their track record of delivering good risk-adjusted results for shareholders? Do they have a track record of demonstrating that? And if they don't, I think that's another checkbox that you if it's unchecked, you got to just move on.
Okay. So, the inflation argument has been probably the most common debate on my channel over the last 6 months. And so, more real now than ever, exactly what you said, all the inputs, whether it's labor, fuel, any durable goods, right? We're seeing the cost inflation making this model more attractive. So I think investors are being rewarded for that right now if they've made those decisions to get into royalty companies over the last 12 months. You talked a lot about expertise. And so let's give you the opportunity to talk about your team a little bit. I know your background, prior to Vox, you were at Roth Capital. And I believe for about 7 years, something like, correct me if I'm wrong, about $1 billion in transactions or capital raise. Touch on your background, what inspired you? Because from the jump, did you start Vox? Because I know you guys have modeled the Franco model in terms of the commodity split. So was that what you learned at Roth that you then said, let's do this? Let's start Vox with this model? What did you see there?
Yeah, also staying at Colorado School of Mines and really kind of all that work together to say, there's an opportunity here. Frankly, it was, having been on the investment banking side of the wall and helping a lot of royalty companies and helping companies sell streams and royalties to some of the majors, it was very insightful in terms of really the advantage that the royalty companies held in that context from their exposure with their limited risk. Their exposure to the upside with limited risk really, really stood out. And so you look at the companies that were material back then, this is 2010, 2011, Sandstorm's just getting started, Royal and Franco and Wheaton are a fraction of the market cap that they are today. Cisco Royalties, which took some twists and turns, was essentially incorporated slightly after I incorporated what is now Vox. But what really inspired what is now Vox Royalty Corp was, frankly, the disappointment from investors in the risk-adjusted returns in buying juniors. I helped raise hundreds of millions of dollars in the junior space. And at the end of the day, as an investment banker, you had very little control over how your clients ended up performing and did they deliver for investors. And the mining industry has just a very stained track record in terms of risk-adjusted returns and what they end up returning to investors. from a returns and cash flow perspective. And so I went about looking at what has already been done and what's been successful, and what can be done to make it more successful and bring that torque that the junior mining investors are looking for in the format of a royalty company and deliver those better risk-adjusted returns. And so that's what I set out to accomplish, but for shareholders. And so we started with $7.5 million back in company. We raised the money back in 2013. Company was formally incorporated in 2014, and we've delivered on that. And it was really because investors were at the forefront and the focus of the opportunity, and that was the problem that we believed we were solving.
And is it fair to say that you've modeled the commodity split off of Franco specifically?
Yes. I mean, Franco, it's interesting in that you've had other royalty companies come along over the last, call it 5-6 years, that have said, well, we're going either all precious or all battery or, who knows what, some, obscure mix that they deem the appropriate mix. We looked at it and said, well, Franco started really before everyone. They have carried the highest multiple, created the most value in the industry. Why would you go off of that? There's a precedent. And how did Franco build most of their value? And we didn't start with, we knew a lot of what we know now, but we didn't know some of what we know now. And so we've continued to hone the business model, but it was absolutely, exposure to just one commodity or one bucket of commodities is not going to deliver the best risk-adjusted returns. And so Franco having that kind of 70-30 weighting precious to other was something certainly that we were targeting, and we've built critical mass around that weighting.
Okay. And so let's jump into that critical mass, as you said, because I think you're sitting on over 50 royalty and streaming agreements, 49 of which have been completed since 2019. Is that correct? So talk to me about sourcing these agreements, Kyle.
Well, in the context of what you and I started talking about at the jump was the quantum of new royalty companies that have entered the market. Most don't have any competitive advantages. And that was another check mark that in the list. You're asking me these questions on the fly, so I'll go back if I think is something really relevant. But one of the check marks needs to be, what's your competitive advantage? How do you source your royalties? How do you source your opportunities? Different companies have tried different angles to source opportunities without the competitive pressures that you find. There's, on any given month or week, there's 3 to 4 processes being shot by investment bankers to buy royalties. There have been a few major transactions announced recently, all shopped. Well, if you're the highest bidder in that process, you've got to ask yourself, there's this theory of the winner's curse. So if that's all you're doing is winning shop processes, are you really creating value for your shareholders? Debatable. The industry's grown that way and been successful, so there is room for debate on either side. But we built our business model to generate this type of deal flow at great value. And it's the competitive advantages that we formed in terms of intellectual property, a technical team at the front lines of our business, and deal sourcing agents around the world that we call connecting the 3 legs of the stool that lets us find very significant volume of opportunities at good value.
That's an interesting perspective. I like that. And I haven't heard the term winner's curse, but it reminded me of a quote that I heard earlier in my entrepreneurial career. I was actually a mentor of mine who said, if you're not hearing no or getting no on a regular basis, you're not pushing hard enough. And it made me think of that immediately. So let's jump into the details of Vox. Talk to us about revenue projections, where we're at today, and any highlights within those present royalty and streams you want to touch on and make sure investors remember.
Yeah, I'm so excited about our portfolio. I have to kind of maintain a rational level of exuberance on it. But we came out with guidance. Our original guidance for this year was $2 million, midpoint, $2 million CAD of revenue. We've doubled guidance over the last 2 weeks to between 4 and 5 million CAD in terms of top line revs. What's really exciting about that is not from one royalty. It's from 5 royalties. We bought all of these royalties essentially when they were in a pre-revenue state. Only one was essentially already producing revenue. And so that was one of our core areas of focus, was finding royalties that were under the radar screen, that were 3 to 24 months out from production, that our mining engineers and our geologists were really confident would produce great results for our shareholders. And we bought those royalties at great value for where they stood at that point in time. But when you factored in what our geologists and our mining engineers expected those royalties to do, we expected them to grow significantly, exceed what we had projected internally, and deliver these types of returns for investors. And so analysts had us doing $2 million this year. We obviously are expecting to far outperform that. Following years, we have not come out with formal guidance, but analysts have us going from 6 next year to 8 the following year. And obviously we've been on, a pretty interesting trajectory compared to analysts' expectations.
And who's providing this coverage?
So right now we have 3 groups covering us. We have Paradigm, Red Cloud, and Cantor Fitzgerald.
Got it. Okay. And I know you're global with these projects in Madagascar, Brazil, but I believe 80% of the portfolio is North America and Australia. Is that correct?
Yes, indeed. And we've made that a focus. We want to maintain a very low overall threshold of geopolitical risk in the portfolio, and obviously Australia, in particular Western Australia, where we become Australia as a whole. We're the second largest holder of hard rock mining royalties after Franco, Nevada. Most of those are Western Australia, and Western Australia, according to the Fraser Institute, is the best jurisdiction for mining and mining investment, which we would wholeheartedly agree with.
Got it. Okay, so outside of rev projections, let's talk about news flow. We know the story now. I know what my viewers are going to be hitting up in the comments is, but what are the trigger points? What's going to move the share price in the next 12 months? So what can we expect?
Look, I believe continued expectations to the upside in terms of what our assets are going to be generating revenue. One of the big assets that was not generating revenue in terms of where we were last quarter, so that did not factor into the revenue that we hit, is we had first gold pour at the Segilola asset operated by Thor Explorations. So it's the highest grade open pit in West Africa. They just announced first gold pour on July 30th. So that is going to be ramping significantly for us. That's a nice and a meaningful catalyst for us. We're expecting 2 or 3 more projects to come into production over the next 6 to 9 months, possibly more. Those are going to be nice and significant announcements for us. And then we continue to have just what I believe really separates our portfolio is we have 20 plus projects that we would say are fast tracking development. And those projects are going to continue to produce news flow that will demonstrate the latent value, the value that we're not getting credit for in the VOX portfolio. And then alongside that news flow is we've led the industry in terms of royalty acquisitions over the last 2.5 years, almost 3 years. I believe we're going to continue to lead the sector in growth, but we're doing it on great assets at disciplined valuations. And so those new acquisitions, I think, will really move the needle for our shareholders.
I love it. Okay. 2 to 3 projects moving towards production, 6 to 9 months, 20 plus development projects on the fast track towards something. And obviously, you're still shopping. Aggressive.
Always shopping, always utilizing the competitive advantages that we built to produce great opportunities for our shareholders, and excited that our model continues to be validated.
I love it, Kyle. Look, thanks so much for coming on. It was great chatting with you and getting you in front of my audience and getting to know you a bit better. I'd love to stay in touch and check in, 6 to 9 months down the road, right? And see how this is going.
Absolutely. Jay, it's been a pleasure.
As always, if you enjoyed this content, please hit subscribe. I'd love to have you on the team. And if you want to take the next step and go a bit deeper with my content, I publish a free weekly newsletter every Friday where I debrief my portfolio. I distill the top lessons I've uncovered from the guests I've had on this show every week. And I talk about sectors and industries that I think are poised to move, areas I'm looking for opportunity, and places that I'm allocating capital. I love writing it. We publish every Friday. The link is right beneath this video. Love to have you join the tribe.